Mark, it's great to see you. And tell us how you kind of worry this could play out.
Sure. Well, first of all, thanks for having me. So we are worried that inflation could remain more persistently elevated than the Fed currently anticipates. Right now, they think that they'll see inflation slow to 4% by the end of this year and close to 2.5% by the end of next year. And if that happens, then the Fed can probably get away with a hiking cycle that doesn't really hurt financial conditions all that much. But the risk here is that inflation stays elevated and the Fed needs to move underlying real rates, those rates adjusted for inflation, into positive territory. And as they do that, there is a risk that it could tighten financial conditions a little bit more broadly, thereby risking a more severe economic slowdown.
Mark, let me frame the question this way. Is the trade-off, and some might say, look, if this is the trade-off, if we can take barely positive growth in exchange for 3.5% inflation instead of 3%, wouldn't we want to take that trade? I mean, how important is it that the Fed gets inflation down to 3% or below versus a little bit above that level if the difference is, a recession versus avoiding one?
Yes, and it's a real balancing act for them. We think that ultimately the choice for them comes down to what are inflation expectations doing? If inflation expectations remain anchored and we see inflation that settles in around 3%, then the Fed might indicate a slightly higher tolerance for inflation in favor of a recession. But if we do see inflation expectations become unanchored and shift higher, then the Fed is going to probably be favoring trying to really lean against inflation, get those expectations lower, even if that means potentially causing a recession.
Hey, Mark, it's Eamon Javers here. As I look at this, I'm wondering whether or not the Fed has to do this all on its own, right? I mean, last fall, everybody was talking about inflation being transitory. There are all these factors in the economy that meant inflation was going away. The supply chain coming back from COVID, all those things meant inflation would sort of naturally peter out. Are those things still in play? That is, will inflation sort of have some petering out effect on its own, or does the Fed have to do all the heavy lifting to get this thing turned around at this point?
Yeah, there's a great phrase in markets, and that's the cure for higher prices is higher prices, meaning that as prices increase, you will eventually see demand destruction.
At some point, you run out of customers, right?
Yeah, exactly. There is likely going to be some element of that. Certainly, we have all felt higher prices at the pump. We've all noticed higher prices in the grocery store, and that to some extent will mean that folks just don't have as much disposable income to spend on other things. That will naturally somewhat moderate growth, and that can moderate prices. But the real question is, how far does the Fed need to go in order to see the economy come back into equilibrium? And what we worry about is that right now, what the Fed is indicating really only gets real policy rates, again, interest rates adjusted for inflation, back to zero really towards the end of next year. And the issue that they could face is that they're going to have to get those real interest rates positive, and that can start to bite. That can begin to slow growth a little bit more, and that can also hurt financial conditions and tighten financial conditions as a means to get the economy back into a better equilibrium.
Mark, backing up for a second, is it fair to say that given the steepness in the yield curve, the fact that break-evens have come down as the Fed has really ratcheted up the hawkish rhetoric, that the market actually is responding well, or to put it bluntly, likes what it's hearing, as scary as it kind of sounds?
Yes. Well, I think it's safe to say that the market has repriced real rate expectations higher materially. And even as that has happened, what you have seen is that you've seen that financial conditions have been remarkably resilient. Now, the question is, will the Fed be agile enough to respond to evolving inflation data as we see it? Meaning that if inflation does indeed start to decelerate, will the Fed dial back a little bit? Or is there a risk that the Fed could potentially overdo it? That, we think, is the big risk for markets today. And it's quite likely that the Fed is going to have to get real interest rates into positive territory in order to ensure that demand begins to fall back into a better balance such that prices begin to stabilize.